So let's go on and get a practitioner's perspective. We've got Vinay Jaising he handles the JM Financial PMS and has been around for a while. Vinay, afternoon. Thank you so much for your time. Before I talk to you about your portfolio approach, I want to understand in trade or on flows front, how much is India's reliance on overseas ecosystem that we are falling like this? I want to understand, is this nervousness justified? US yields are rising good, but what kind of impact are we vulnerable to for that?
Thanks, Ajaya. So if this question was asked by you a year or two ago, at that time, the degree would have been much more, which was India depends a lot on liquidity to global markets historically. Having said that, today, seeing what inflows have been coming from retail India, the SIP data, month on month, giving you stronger numbers. They've grown more than fourfold in the last 5 years, and they're really growing a lot more aggressively than one could have imagined. And this is sticky inflow retail data coming in. So the dependence on global liquidity has reduced. Having said that, if I look at the FII ownership today as a percentage of, let's say, the BSE 500, it's at around 18%. 2 years ago, it was 20%. So if we believe India is a $4 trillion market cap company, there is 2% of catch up, which will happen as the global risk of trade, as you mentioned, happens, because India clearly has a lot more resilience in earnings, because of which it becomes a bigger risk of trade. Two comments I would make more out here. You've already about bond inclusion for India and EM index. That too should improve the liquidity for the country by $24-25 billion. So you can see a lot of inflows coming in from FIIs, be it in debt or in equity, in the next 12 months. Also, remember one more parameter, interest rates in US have gone to a bearish stance, which means the 10-year has moved to 4.84%. as against the 2-year, which itself is at close to all-time high of about 5.4%. So this spread of negative 0.3 basis points has happened in the last 6 months. Both the 2-year and 10-year have moved up between 120 to 150 basis points. So there are concerns in US, and yes, we think there could be a lot of economic global slowdowns. Touch wood, India seems to be a lot more resilient than the rest of the world.
The other thing I wanted to highlight and get your views as well, we are, day-to-day watcher of the screen, maybe getting a bit nervous that US yields are at 16-year high. But in absolute terms, is it right to look at it that way? In those 16 years, how have India changed? Dependence on flows, our trade relations with the rest of the world, quality of borrowings, emergence of domestic flows by retail, durability of our economy in terms of reform trajectory, earnings of corporate India, all of that. So would we respond, or our markets would respond in the same manner to rising yields like we were 16 years back?
I think exactly, it should not. And we are saying rising yields, even the US yields have close to peaked out. If you see Fed increase rates, it'll be probably by 25 basis points to 50 basis points at max. Now we are not talking about rising yields as much as we are talking about yields remaining higher for a longer period of time. And that for US is a big problem. Now let me just mathematically explain that to you. Mortgage industry, which is a high proportion of the overall debt in US, between 14 to 15% of debt of US goes to the mortgage industry. Now, that industry has seen interest rates move up from probably 0 plus 2% to 5.5 plus 2%. So it's moved up, invariably for a customer to 7.5% from 2%. So there's a 3.5 times increase for the mortgage rate in US. And as you're keeping on turning on a floating rate basis, your next quarter's payments, you're paying a lot more. They get hurt. In India, you've seen interest rates virtually in 2 years being, more or less flat. We've seen higher interest rates actually 5 years ago than what is prevailing today, even for the 10-year, the 10-year charts at 7-ish%. You've seen higher interest rates in India. So India is a lot more resilient because we've seen a lot more of higher interest rates. US's interest rate, let's say for the mortgage industry, is 3.5 times. It may be 5.5%, but it's 3.5 times of what was earlier. That pain is not there in the country. So India is a lot more resilient. Even if I were to look at other parameters like GDP growth, remember India's profitability is only 1.5% of the overall world's profitability. But incrementally, we are today adding between 10% to 15% of the overall GDP of the world. So we are contributing a lot more to what's being delivered or growing for the world as a whole. So I think India should be shunted relatively, but yes, can you see markets being sideways in the medium term? Yes, you can. As the quarterly results start coming out again and you start seeing India growing in the 15 to 20% per annum level, you'll start seeing the market having wings again, and all the focus will move away from the global trajectory to probably just the earnings trajectory for the country.
All right. How does your, what kind of names are you researching and keeping on your radar if the market, if you get the same kind of names, 15, 20, 25, 40% lower, you would be keen on loading up on?
So, yes, we have increased our cash position in the last month by close to 9%. We are betting on three sectors as such. The first sector is the consumption. We've seen that the banking sector, the loan book growth is great. And there are some small and mid-cap names wherein we are seeing the loan book growth being very, very high. Very, very high means 15 to 20%. The second space we are looking at in a very big way is the capex space. We've seen the Indian government front end the capex even in a year like this, the election year. We've already increased the capex in the budget by about 5.5 to 6 times in the last 10 years. And that's in defense, in railways, in water. So we are very excited in the capex space. Some of the stocks have become expensive, but there are many, I would say 10 to 12 time PE stocks with high return on capital employed, which we are focused on as well. And the third space we are looking at is the Make in India story. Though we are relatively underweight the IT space, we want to play the dollar play by playing some chemical names wherein we believe there are EV stories in the future, companies like Tatva Chintan, and that's where we are really focused on. So, we are nibbling in them currently, but yes, some expensive names in defense as they correct, we're starting buying them. And even today, I think there are lots of stocks where we are buying it, considering that 1 year forward earnings for them are at a 20 to 25% P, CAGR.
Right. Some of your global kind of sectors, IT, pharma, is it time, are they offering good value?
So as far as IT is concerned, we've been cutting down our position. As far as energy, another globally linked sector, we are cutting our positions. In the case of energy, we are cutting down positions because when crude oil prices move up, OMCs get hurt. That's a similar logic. In the case of IT, our biggest concern is as interest rates keep on moving up, we keep on thinking that the slowdown in services sector for IT globally will be behind them, and you'll start seeing again earnings growth or revenue growth go to the 8 to 10% level. We are not hearing that part in discussions or in results which are coming out. We are actually hearing there's one more quarter of pain coming in. So we are muted there, but there we are playing more mid-cap names in the IT space. In the pharmaceutical space, there's one company, I would call it quasi-pharmaceutical space, which we recently started nibbling into, which is Concord Biotech, a global fermenter with a 20+% market share globally in immunosuppressants and close to 45-50% market share. So we're buying companies which have high quality earnings, which have strong moats, and where return on capital employed are north of 20 to 25%.
Right. All right, Vinay, we'll let you go on that one. Thanks so much for your time today.